Hello, everybody, and welcome back to my next episode of quantitative oil trading with virtual barrels. We're gonna do one more episode around the hedge fund flows, but we're gonna consider two interesting strategies and very timely how discretionary traders now can use some information that they can derive from flows of systematic quantitative funds. So we're going to talk about two strategies, one following the crowd strategy and the other one fading the extreme positioning. Um, so these two strategies, I usually call them so-called quantamental strategies. In the first three episodes, we talked mostly about entirely rule-based strategies, which are generally referred to as systematic trading. So this is really what the quantitative hedge funds do. They obviously do not trade oil only. They trade all commodities. In some instances, they also trade many other asset classes. So they tend to diversify their bets across different assets. So my focus in this series, at least for now, specifically on one asset class. So in one asset class, if you're trading oil only, there is nothing to diversify. You're really betting on a single commodity. Therefore, in the oil market specifically, the diversification comes from your discretionary components, from some insight that very often professional oil traders derive from the assets they may have, from some fundamental information, and frankly, from the interaction with other market participants. So I have never been myself a systematic oil trading. I have always been a model obsessed person, but ultimately the success in the oil trading comes from blending the systematic trading with some of the discretionary insights. So I always refer to it as an oil market, the human equipped with a machine is gonna beat either machine or a human alone. Some people can challenge me on that, but that so far have been my experiences. So this trading style where you're trying to blend the two together, I generally call it a quantamental trading. So today we're gonna sort of talk about one quantamental strategies based on hedge fund positioning. And we're gonna cover more strategies as we continue with the series, how we use quantamental trading using fundamental information, macro trading, etc. So we're gonna start again with the first quantamental strategy based on a hedge fund positioning, because as you recall from my previous episodes, hedge funds were the primary winners in the futures market. So let's try to figure out what they're doing and how a discretionary trader can use that information. So this mini lecture is based on a few things here. First of all, it's in chapter 6, or specifically section 6.5 in my book that sets the stage, explains these two strategies, but it doesn't really do any numerical calculation in the book. So we have done this calculation in a couple of papers. One is, again, in both of these papers is a joint work with Jonathan Sun, who is a research fellow in CAPSARC, which is Saudi Arabia Petroleum Institute. So we published a paper earlier this year about the speculation in the oil market, and a new paper that just coming out in the Oxford Energy Institute, again with Jonathan Sun, where we improved some of the method in the previous paper, changed the methodology, and edit a second strategy as well. So you can find this paper by going to my webpage. It is Oxford, and you can find it there. All right, let's get going. So the first strategy is following the flow. So as I said, the fast managed money are the primary winners in the futures market. If you want to refresh your memory, go to the previous episodes. We describe who they are, how they trade. So they tend to follow momentum-based strategies and carry-based strategies. So the idea here is very simple. So if you're not a systematic strategist, can you simply mimic what they do? If they're the smart money, can we design a strategy which I call follow the smart money or follow the flow? In other words, as soon as we know what they do, we're gonna do exactly the same thing. So we're just gonna replicate to the best we can of what they do, and we're gonna try to see if this strategy is gonna be profitable or not. So specifically, what we're gonna do, we're gonna define now a momentum. Remember momentum, we already talked about momentum strategy in the connection in the context of prices. But now we're going to define momentum on positioning of hedge funds. So we're going to again use a crossover of moving averages. So we're going to calculate the moving averages applied to positions held by managed money, and we're gonna use two moving averages, M and N, where M is a shorter one and N is a longer one. And the strategy is very simple. If the short-term moving average of positions exceeds the longer-term moving average of positions held by hedge funds, then we buy. So in other words, if they are buying because the short-term moving average exceeds the long-term moving average, the difference between the two shows you the change. What have they been doing between this week M and N? So if they were buying, then we're gonna buy. So if moving average in a shorter period M drops below moving average N, we sell. But again, here the moving average is applied to positions, not to prices. We can only, of course, implement this strategy with a lag because the positions are held by hedge funds reported by regulators on Fridays. On Friday, the positions are reported as of Tuesday. So, in other words, the regulators report positions with a 3-day lag. So, and Friday after the close, so we can't really initiate our trade on Friday. In theory, we can do it over the weekend, but I want to keep this thing simple. So we're gonna wait until Monday to basically react to the information that we learned on Friday afternoon. So there is almost 1 week lag. One important point to mention here, which applies to all momentum strategies. All momentum strategies, specifically the ones based on a crossover of moving average, they're extremely sensitive to the look-back period. So, and I cover it in chapter 5 of my book. I explain why in very detail. Feel free to take a look. So by changing this look-back periods M and N, you can get all kind of stuff. The momentum strategy is extremely unstable. So many analysts, unfortunately, trying to cherry pick the best performing M and N that generate you the best looking backtest analysis. We're not going to do that because that's one of the pitfalls with systematic strategies, that analysts are trying to impress their clients and their bosses, and they're trying to over optimize parameters. What we're going to do, we're going to approach it with slightly different and novel methodology. So we're going to randomize these parameters. So first, we're going to define the set of parameters for which the strategy looks kind of okayish. And here, we're going to use this set defined by the short-term moving average from 1 to 4 weeks and the long-term moving average from 8 to 26 weeks. Basically, the short one goes from 1 week to 1 month. The long one goes from 2 weeks to 6 months. So in each cell here, it's a heat map, shows you the Sharpe ratio for the strategies that's managed with these two set of parameters. For example, the best one, you see the dark blue here. It appears to be around moving average, when moving average like 2 weeks crosses with about 10 weeks. So you can say 2 week versus 2.5 months. But all of this in this area generally work pretty well. That's for brands, kind of similar for WTI as well. So, but instead of choosing this one, because if you choose the optimal one, the optimal ones tend to be the least stable out of sample. So we're not going to choose the optimal one. What we're going to do every week, we're going to randomly draw a pair of parameters from this range. Just randomly draw it. And we're going to calculate our signal for the following week based on this random draw of parameters. So the next week we're going to draw it again and we're going to calculate a new signal and hold it for a week only. So we're going to continue this process and we're going to repeat it a million times. So we're effectively going to generate like a Monte Carlo simulation by repeating this strategy a million essentially times with a randomized set of parameters. And then we're going to group, we're going to calculate P&L for each run, and we're going to group this P&L by percentile with 5% increments. So essentially, the medium one, or the mean, is going to be the most interesting one. That's like the least optimized. That's a green line here. But you can kind of, this is a cumulative P&L shown as an equity line. Cumulative P&L is also often referred by traders as an equity line. So you can see the green line is the least optimized. So the obviously top percentile, you generate better performance. The bottom percentile, you generate slightly worse performance. But it's showing you that all of them generally have a similar shape. That shows you the strategy is fairly robust. And by the way, a similar thing on WTI. So the 50th percentile gets you around 54% Sharpe ratio, similar again on WTI. But what's interesting, you can see the strategy performed extremely well from 2012. By the way, the data on positioning, the disintegrated report started to get published in 2011, and we need about a year to calculate the moving average, so we can only start this following the flow strategy or following the smart money basically from 2012. So if you can see from the very start, the strategy had a marvelous performance for about a decade. And then after 2012, it kind of flatlined. So it wasn't making any money in the past 3 years. Like after COVID, the lines are flat, and it doesn't matter almost which percentile you pick. The medium is fairly flat. Even the top performing ones stopped working. So that's an interesting. So the strategy worked really well for 10 years, but now it's no longer working. So it's not losing money, but it's no longer making money. So the question is why? So are we really are we really moving into a new regime? So let's try to kind of shed some light on that. Well, the first thing we're going to do, and that's going to be a valid challenge if people can ask me, well, hold on, Ilya, if managed money favor a simple price momentum strategy, and you show in a previous episode, you can actually explain the behavior of smart money by using price momentum, then isn't following the flow just a version of this price momentum strategy? That would be a really good challenge. So to kind of address this, what we're gonna do, so we're gonna apply the same methodology to price momentum strategy. In other words, we're gonna randomize the parameters. We're gonna define price momentum as a crossover of moving averages, and then we're gonna split it all in a percentile and do the equity line. So we're gonna apply exactly the same methodology for price momentum and for our following the flow, and we're going to compare the two. So those are the median 50 percentile for both. The blue line is following the flow. The orange line is a price momentum. So think about it, the blue line being the positioning momentum, the orange line being the price momentum. You can see that the following the flow actually is working better than the price momentum. What it's telling you, well, then the hedge funds actually know something more than just following the price momentum, because they simply following their behavior is actually doing better than simply following the price momentum. So they clearly know something. The other interesting insight comes from the same data, but it's graphed in the form of a scatter plot. So you can see a lot of the points here are on a 45-degree line with a slope of 1. And here again, on the horizontal axis, you have a weekly P&L from following the flow strategy. on the vertical axis, your price momentum. So generally, they're highly correlated most of the time. Most of the time, basically, when the price momentum is up, the hedge funds are buying, and they're making money as well. And the same thing on the downside. But you can also see the opposite line with a slope -1, kind of 135-degree line. So what that means on certain times and certain weeks, the hedge funds are actually doing the opposite of price momentum. In other words, they're actually smart enough, or some of them are, to take the other side of momentum, effectively trade for mean reversion. This pattern is not as strong as the momentum one, but clearly it's telling you something here, that they're not always momentum traders. There are periods when the mean reversion, and by mean reversion, I mean buying low, selling high. And momentum is the opposite. Momentum is buying on the high, selling on the low, thinking that the momentum is going to continue. But the mean reversion, on some weeks at least, dominates. That's an interesting insight. So the interesting insights we actually gonna try to explore now in our second strategy. So the second strategy is effectively a mean reverting strategy. I do describe this strategy in the book without going into the numerical calculation, and I'll explain why it's not in the book. Simply because when I was finishing the book, the strategy really wasn't working well historically, but it was about to change. So the way how we're gonna define this strategy, so we're gonna compare first how extreme the hedge fund positioning today versus some kind of a history. So there are different ways to normalize it. I particularly like this concept which I call the sentiment index. So what you do, you take today's position of hedge funds and you calculate the percentile. In other words, you subtract the minimum over the period, and in the bottom you have the range. So in other words, for example, if the current position is at the minimum, the sentiment index is 0. If the current position is at the maximum, your sentiment index is 1. If you're about halfway through, that's gonna be 50%, 0.5, and etc. So it's a number between 0 and 1, essentially a percentile of how extreme your positioning versus versus the position over a certain period of time, which I define by n week. So that sentiment index depends on a number of weeks, and it's obviously going to be different depending on the look back. So there is one parameter called n. And the strategy is a contrarian one. So if my sentiment index is very low, less than some number epsilon, in other words, the position is very, very short, I'm gonna buy. So when hedge funds are extremely short, I'm gonna buy, I'm gonna take the other side of their position. Because the idea is there is a certain limit so if that they can, how short they can be. If all of them are already short, the positioning is very stretched. The trade becomes crowded. That's why I call this strategy fading the crowded trade, or in other words, fading the extreme positioning. So I'm gonna buy when my sentiment index is close to 0, and I'm gonna sell when my sentiment index is above 1 minus epsilon, or basically close to 1. So and I'm gonna choose a range of epsilon. I'm gonna choose again the set of parameters. So I'm gonna use my epsilon from 0 to 20%, and I'm gonna use my look back periods from 3 years to 5 years. I didn't include my heat map, but you can construct a heat map similar to that, where you have n on one axis, epsilon on the other one. I didn't include them here for simplicity, but you use the same technique with randomized parameters, where each week you sample epsilon and you sample n, and you hold the position for the following a week. So again, this is done to avoid overfitting. So we apply the same methodology, we run it 1,000,000 times, and then we're gonna look at the 5% at the cumulative P&L broken by 5 percentiles. So again, you see the interesting thing here. So the strategy was a disaster until basically until roughly around COVID. In other words, it was not a good idea to take the other side of the smart money until 2021, 22, regardless of how extreme their positioning was. In other words, you would have lost consistently a lot of money. But what is interesting here that things have started to change. And that's something that I was alluding to in a book. I couldn't really pull all the graphs because I was finishing the book in 2023. That just was about to happen. And now, if you look at the subsequent 3 or 4 years, the strategy of fading the crowded trade, of fading the extreme positioning, started to work extremely well. And again, you can see it in the 50th percentile, it gets you 77% Sharpe ratio. Obviously, the top choices are even higher than that, close to 1. But the strategy has been working really, really well. So is it really a regime change? So you can see, like, for example, by looking at this strategy and comparing it to this one, so the following the flow strategy worked well for a decade, but then it stopped. It's not losing money, it stopped working. And fading the crowded trade didn't work at all for a decade, but now it's working quite well. Can we really say that we are going into a new regime? It's a bit difficult, honestly, to answer that question because we just don't have enough data yet. But one thing to keep in mind, remember that systematic funds trade based on historical patterns. And when these patterns change, they change their strategy as well. The long-term historical patterns clearly favor momentum type of strategies. But the shorter term patterns are clearly favoring the mean reversion type of strategies. So at least over the last couple of years, the hottest trend in the industry was to basically fade the position held by the previous trend setters. In other words, take the other side of it when their positioning becomes extreme. And the final slide in this lecture, I only talk about the hedge funds. What if you apply all of these to other market participants? Remember, there are 4 categories: the hedge funds, the PMPU, producers, inventory hedgers, the swap dealers, and other. You can do that, and we have done it. And there are a couple of interesting observations. So, and they're actually different for Brent and WTI. So it turns out if you apply this following the flow strategies to brand PMPUs, which are producer hedging, the inventory hedgers, you lose consistently money. So in other words, if you do the opposite side, in other words, you counter follow the losers in the market, then you're gonna make money as well. And the Sharpe ratio is you basically flip the sign because that graph is shown from the perspective of following the PMPUs. So if you counter follow them, in other words, whenever they buy, you sell, whenever they sell, you buy, you basically do the opposite. So you flip the sign. And likewise for WTI, if you recall from one of the previous episodes, the losers were the retail people, the other. So if you counter follow the losers or the other, that actually generates you one of the best Sharpe ratios, fairly consistently actually. So again, you have to flip sign here because that graph is from the perspective of following the losers. So if you follow the losers, you're obviously going to lose money. If you counter follow the losers, then you flip sign and you're going to make money and you get about 71% Sharpe ratio. That's not bad at all. The interesting thing, you can do a whole lot more if you start applying the similar technique to the options market. And that's where we probably gonna go next. So in this first 4 episodes, again, I pulled different sections in my book and combined it with some of the papers that we have written subsequently because I wanted everything related to the hedge funds to go together. So that kind of completes my first block of 4 lectures where we covered the hedge funds and everything related to the hedge funds. So the next block, my plan is to go into the options, and I hope I'll record my first video on the options fairly soon. But for now, as I said, leave me feedback, subscribe please to the channel, share it with your colleagues, and looking forward to hear your feedback. And see you soon.